Trump says his plan for 25% tariffs on Mexican and Canadian goods is due to take effect this coming Tuesday, along with an additional 10% duty on Chinese imports. But our guest says there are ideas here for portfolio strategy. Let's bring in Eric Beyrich, who is co-chief investment officer at Sound Income Strategies. Thanks very much indeed for joining us.
Thank you for having me. It's a pleasure to be here.
Could you, do you have any reaction to that shouting match in the White House and the Oval Office?
Well, I think you'll get a lot of reactions. In one regard, it was embarrassing because I think Zelensky was being quite respectful and Vance and Trump were not. So, you know, all Americans are not sure how to process the style of Trump. Mm-hmm. So, I don't know what else to say.
Yeah.
I think as far as the markets go, you know, Trump is a difficult person, but he's a breath of fresh air economically versus the past administration. And simply because he's talking about doing, you know, helpful things like deregulation and lowering taxes and trying to make the government more efficient. Mm-hmm. Those things are great goals, as is the goal of world peace. Mm-hmm. We don't really expect, I don't think, that he'll achieve all of those goals. No politician really ever does. But at least those are steps in the right direction. But as far as the markets go, that news was not as important as the news coming out of the Atlanta Fed about the GDP slowing down or the PCE numbers coming down, which gave some hope that the Fed might come back to the table and lower rates, which would be very helpful. So, you know, we have this peculiar thing where the media is all exercised by Trump because he's a guy who antagonizes some people. Mm-hmm. And the markets are really focused on economics. And the markets definitely behave better when there's stability and constancy. But the media, I think, often portrays these tariffs as if that's policy, as opposed to that is leverage to get the policies that they want. And for the most part, that's really what I think I interpret them to be, is it's a cudgel to try to get people to do things that he wants with threats. Mm-hmm. I don't really care for that style, but I don't really expect us to have, you know, basically the holy tariffs revisited and the global economy to come, you know, shutting down, which I think you get some of that reaction by people who have stronger political views as opposed to economic views.
Tell us why. What is your explanation for why investors have gone cool, or at least cooler, on artificial intelligence and tech lately?
Oh, that's fun. I think there's two things. We had the DeepSeek phenomenon, which basically said maybe we don't have to spend the billions and billions of dollars that Carl Sagan might speak of to get the AI that people are chasing. But I also think it's just the law of large numbers. You had 2 years where there was very little growth anywhere except for in AI technology. And, you know, there was some GLP-1 drugs and things like that, but that was it. So in a world that had a dearth of growth opportunities, suddenly AI emerged and it grabbed everyone's attention, everyone in business's attention, because it promised to save costs, and every investor's attention because it offered growth where there was very little growth to be found elsewhere. Now, after 2 years of, you know, extreme growth, 100% kind of growth, the growth rates are slowing down. We always talk about calculus. Remember, back in school days, you know, you had first derivative positive, second derivative positive. Well, we have still first derivative positive growth. In other words, the world is improving and growing more, particularly in technology. Even NVIDIA still has 50% earnings per share growth. But it's second derivative negative. In other words, it's decelerating. Mm-hmm. So it's one thing to pay, you know, 50, 60, 70 times earnings for a company where the growth rate is accelerating, and you could imagine, you know, all kinds of fantasies of massive numbers. Mm-hmm. But suddenly when things are decelerating, those asymptotes start going down and the fair market valuations fall. And that's what we've seen, that expectations got a little bit ahead of reality, and you need to digest what's been done. And now there are other things that are growing and improving. So the market is naturally rotating away from what have been the best stocks for the last 2 years and looking for other things to do, because there are a lot of other things that are cheaper by a lot. Mm-hmm. And that offer economic growth or economic progress, if you prefer.
Let's get to some stock ideas here. Perrigo, P-R-G-O. Remind us what they do. Why do you think this stock has potential?
Okay, Perrigo, I wanted to sort of pull away from that because it's just up 20% today, and I don't want it to look like we're touting our winners to sell them. We're not. But Perrigo is the largest maker of generic healthcare, over-the-counter healthcare products in the world, and it suffered a problem over the last couple of years with baby formula, and they're changing the rules on baby formula, et cetera, that caused their earnings to be volatile. Well, that episode is now past, so even today, after the stock has risen 20% on its good earnings report and outlook, it's still trading at less than 10 times earnings. It's only 9.5 times earnings, pays a 4% dividend. And normally this stock trades at 16 times earnings. So you've got significant scope, more than, 50% upside just in the price alone to get back to normal. Plus you get paid a 4% dividend along the way. And it's a well-run company. And so if people economize, which is one of the themes that we're seeing in the world now, they're going to buy more private label products, and these Perrigo is a beneficiary of that. So that's one of the stocks that we own that's having a great day today. We can talk about a number of names. I don't know which ones on the list you'd like to talk about, but I'll be happy to talk about anything you want.
Unfortunately, we have only time for one more stock. Corebridge Financial, they're a life insurance and annuity company, yield just under 3%. Why do you see potential here?
Well, this is a situation where annuity growth has been phenomenal. And what it is when you couldn't get interest rates on annuities, people weren't buying them, but people like the idea of having a secure income stream. And this stock is trading at only 6.5 times earnings. And it's the spin out from AIG, basically. So as it gets itself more efficient and it proves that these strong earnings that they're realizing are durable, that it's not just the flash in the pan, the multiple might bid up to what a normal life and annuity company multiple would be, which is in another case, it's almost 50% higher than where it is now. So that stock has done well. It got an upgrade today. It's up $1.40 today, which for this stock is a 3-4% gain. But those were two that I wasn't going to talk about because they've already had great moves, and there's more to come. But there's plenty of stocks like these where they're very inexpensive on either an enterprise value to EBITDA basis or a cash flow basis that the market has ignored because they didn't have strong top line growth like the AI names did. And now people are saying, well, wait a minute, they actually are so cheap, much below not only the market, but their long-term averages, and they're improving. Now's the time to start buying them, especially if interest rates fall further.
We're going to have to go. Eric, thank you very much. Really enjoyed it. And you have other ideas. We'd love to have you back soon if you're free.